Welcome to StockTok's deep dive into UBS Group AG. UBS is one of the world's largest wealth management and universal banking institutions, headquartered in Switzerland. The firm operates across three core pillars: wealth management for high-net-worth individuals and families, asset management serving institutional and retail clients, and an investment banking division advising on mergers, acquisitions, and capital markets activity. These are the franchise pillars that generate the revenue and returns that attract institutional capital worldwide. The stock over the past year has traded as low as $30.36 and as high as $49.36, positioning it in the middle of that range historically. As of May 11th, the stock is trading at $45.12. Let's work through the fundamentals, scene by scene. Starting with a quick business overview. UBS generates revenue through client advisory fees, net interest income, the spread between what the bank earns lending money and what it pays on deposits, and trading commissions. The competitive moat rests primarily on scale and brand credibility. UBS serves ultra-high net worth clients who demand seamless global banking, which requires infrastructure, regulatory expertise, and relationships that are expensive to replicate. The firm's Swiss heritage and stability anchor client confidence in wealth preservation. On the growth side, management has demonstrated capability in expanding its digital asset exposure and optimizing capital deployment. However, the broader wealth management industry faces headwinds from compressed net interest margins, a measure of lending profitability. As central bank rate cuts erode yield advantages, the StockTok score across 5 dimensions comes in at 44 out of 100, signaling caution. Breaking that down, valuation rates at 10 out of 20, financial health at 7 out of 20, profitability at 10 out of 20, growth at 9 out of 20, and smart money positioning at 8 out of 20. Now, valuation. The question every investor has to answer: are you paying the right price? UBS is trading at a price-to-earnings multiple, or PE ratio, of 15.82 times trailing 12-month earnings. That forward-looking PE of 13.48 times suggests Wall Street expects a modest earnings expansion ahead. The PEG ratio, price-to-earnings to growth, sits at 1.19. which in our view signals the stock is not dramatically expensive relative to its growth trajectory, but not cheap either. The enterprise value to EBITDA multiple comes in at 0.00, a data artifact that reflects the complexity of valuing a diversified financial conglomerate. From a competitive moat perspective, the wealth management franchise carries durable competitive advantages through network effects and sticky client relationships, but the current valuation does not fully reward the quality of those intangible assets, in our view. Let's address fair value directly. Wall Street analysts have a consensus mean price target of $48, with a high target of $58 and a low target of $42. This consensus implies upside of approximately 6% from current levels. Taking that analyst view alongside the forward PE multiple as our baseline, a reasonable fair value range in our view sits between $46 and $52. This represents a modest upside opportunity of 1 to 15% from current price. Most recently, UBS reported earnings from Q1 2025. Approximately 53 weeks ago, the firm missed earnings expectations, delivering earnings per share of 0.82 against a consensus estimate of 0.92. Revenue reached $13.77 billion, which fell short of the $51.31 billion consensus estimate, indicating a significant variance in how the market models quarterly earnings for financial institutions. However, net income totaled $3.04 billion, and revenue growth on a year-over-year basis reached 12.9%, signaling underlying business momentum despite the quarterly earnings shortfall. Market sentiment around UBS leans bullish, with investors citing strategic growth through digital asset positioning, solid operational execution, and positive momentum across financial services sectors. Upcoming earnings are expected on July 29, 2026, with consensus earnings per share estimate of 0.93. Overall, Valuation appears fairly balanced, neither stretched nor deeply attractive, reflecting a market pricing in modest growth but uncertain macro conditions. Moving to financial strength, how solid is the foundation? The Piotroski F-score, a 9-point accounting quality checklist, comes in at 6 out of 9. This signals acceptable but not exceptional financial health, with some red flags that warrant attention. The Altman Z score, a bankruptcy risk model, registers at 0.00, which reflects the challenge of applying traditional manufacturing sector distress models to diversified financial institutions. That metric should be interpreted carefully within banking context rather than as a direct distress signal. On the balance sheet, the cash-to-debt ratio is 0.66, meaning the firm holds 66 cents of cash for every dollar of debt obligations. That is a moderate position, not weak, but not fortress-like either. Debt to equity stands at 3.73 times, which is moderately elevated for a financial institution and reflects the leverage inherent in banking operations. Interest coverage, a measure of how many times operating earnings cover interest obligations, is not available in this dataset, but the debt-to-equity ratio signals the firm is carrying meaningful leverage that amplifies returns in strong cycles, but concentrates downside risk in stress scenarios. The current ratio, typically a liquidity measure, also comes in at 0.00, again an artifact of how banking assets and liabilities are structured differently than industrial corporations. From a credit analyst's perspective, UBS operates with the leverage typical of large universal banks. This is the business model, not a sign of financial distress. However, the leverage does mean the firm's earnings are sensitive to macroeconomic shocks, rates environment, and deposit stability. The foundation is sound but not bulletproof, in our view. Next up, profitability. Is this business actually making money efficiently? Return on invested capital, or return on invested capital, is not available in this dataset, but the profitability metrics we do have tell a meaningful story. The net profit margin, net income as a percentage of revenue, sits at 18.45%. That is genuinely strong. For every dollar of revenue the bank generates, roughly 18 cents flow to net income after all costs, taxes, and financing charges. That represents one of the more profitable parts of the banking industry. The free cash flow margin reaches 39.45%, which signals the business converts its earnings into actual cash at an exceptional rate. This is crucial. It means management has genuine flexibility to return capital, invest in technology, or shore up the balance sheet without being constrained by accounting earnings that don't translate to cash. Gross and operating margins come in at 0.00, again reflecting how financial services businesses don't have traditional cost of goods sold structures. Instead, the net margin of 18.45% is the metric that matters most. Return on assets, or ROA, is 0.55%, and return on equity, or ROE, is 9.94%. The ROA is muted because bank assets are enormous relative to profits, but the ROE of nearly 10% is respectable for a firm with this leverage profile. The earnings stream appears durable, and the cash generation is strong. However, margin expansion looks constrained in the near term due to the interest rate environment and competitive deposit pricing. On to growth. Is this business expanding, and at what rate? Revenue growth over the trailing 3 years sits at 6.7% annualized. Over the past 5 years, revenue growth accelerates to 9.2% annualized. That's a meaningful difference. The 3-year view shows deceleration relative to the 5-year view, which in our interpretation suggests near-term headwinds. Likely the margin compression and rate environment we mentioned are weighing on organic revenue. Book value per share, a measure of shareholder equity accumulated over time, has grown at 10.9% over the trailing 3 years. That exceeds revenue growth, which is positive. It means the firm is growing the capital base available to generate returns faster than top-line revenue is expanding. This typically occurs when retained earnings are reinvested efficiently or when leverage is deployed strategically. The dividend yield sits at 2.46%. That is not lavish, but it signals management's confidence in sustainable cash generation and commitment to shareholder returns. Most recently, Q1 2025 revenue grew 12.9% year-over-year, which is notably stronger than the three-year average, suggesting some inflection may be occurring. However, that single quarter should not be extrapolated. The broader 3- and 5-year trends tell a story of mid-single-digit organic growth in a mature wealth management business. Going forward, growth catalysts center on digital asset adoption, cross-selling into the emerging wealth management client base, and operating leverage if rates stabilize. But consensus expectations are for continued modest growth, not acceleration. Now let's talk smart money. What institutional capital is actually doing with this name? 12 top-tier gurus, as tracked by Dataroma, currently hold UBS shares. That is meaningful. These are portfolio managers with decades of track records and billions under management. However, the direction of their positioning is mixed and warrants careful scrutiny. Richard P. Zena of P. Zena Investment Management holds UBS at 2.65% of his portfolio, but has reduced the position by 10.85%. Samantha McLemore of Patient Capital Management holds the stock at 2.12% of her portfolio, but has reduced by 20.89%. Viking Global Investors, another top-tier name, holds 1.14%, but has cut by 30.3%. Dodge & Cox Funds, a historically disciplined value investor, holds 0.84%, but has trimmed by 21.05%. This is important. The pattern shows top institutional holders are on balance reducing exposure. That is not a red flag in isolation, but it is a yellow flag. When world-class capital allocators who own a stock begin trimming positions, it suggests they are either reallocating capital elsewhere or signaling reduced conviction. On the institutional side, 3.8% of 13F filers are net buyers of the stock, meaning more than half their filings show reduced stakes. This aligns with the Guru positioning. Institutions are not rushing in. Insider ownership stands at 0.0%, which is low. Management owns almost nothing relative to market cap, which in our view weakens the alignment between executives and shareholders. Zero insider transactions over the past 3 months, no buys, no sells, further signals a lack of conviction from the people who know the business best. Overall, smart money positioning is cautious, not confident. And finally, the verdict. Let's bring it all together. Valuation. The stock trades at a moderate 15.82 times earnings with a fair value range between $46 and $52, offering modest upside but no deep margin of safety. Financial strength. The balance sheet carries elevated leverage typical of universal banking, with a Piotroski F-score of 6 out of 9 signaling acceptable but not exceptional accounting quality. Profitability. The business generates an 18.45% net margin and converts earnings to cash at an exceptional 39.45% rate, demonstrating genuine earnings quality. Growth. Revenue has expanded 6.7% over 3 years and 9.2% over 5 years, with recent quarterly results showing 12.9% year-over-year growth, but underlying structural deceleration evident. Smart money. Top institutional holders and gurus are on balance trimming positions, with only 3.8% of 13F filers showing net buying activity, reflecting cautious rather than confident sentiment. In our view, a fair value range for UBS sits between $46 and $52, representing upside of 1 to 15% from current levels. The Q1 2025 earnings miss on both earnings per share and revenue, despite the strong year-over-year growth, reinforces the thesis that near-term margin pressure and deposit competition are constraining results. The overall picture is a mature, profitable wealth management franchise with durable competitive advantages, but facing macro headwinds, elevated leverage, and lukewarm institutional conviction. UBS is neither compellingly cheap nor dangerously expensive. It is a fairly valued business that requires patience and conviction in wealth management demand recovery. This is not a high-conviction buy, but it is defensible for investors seeking exposure to global banking with modest dividend yield. Everything in this video is our interpretation of publicly available data, not financial advice. Please consult a licensed financial advisor before making any investment decisions. That's the deep dive on UBS Group AG. Like and subscribe so we can keep providing you with no-nonsense, data-driven analysis of stocks. We will keep updating our videos as soon as new data that affects the stock becomes available.